Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you here for another weekly market recap featuring Lance Roberts. Hey, Lance, how you doing?
I'm okay.
What a week, huh?
It's been, I think we need to start having this like an hour later so I can start drinking when we do this. So,
Yeah. Well, after this week, look, if you want to have a, Mai Tai in hand here, I don't think anyone's going to hold it against you.
yeah.
All
So
right.
yeah,
Well, look, hell of a week. I'll really let you kick it off here, but sort of two things that stuck out in my mind this week. We sort of had another one of those weeks where we went up and then we came down. Looks like we're going to close, or looks like we've just closed about 100 S&P points down for the week, around 4,400 or so. But a lot of volatility in general, but a lot of news shaping or event shaping news this week. We had the CPI come out, which was still quite hot. And then we had some interesting news today. So why don't I let you talk about kind of what drove your action here? Because I'm sure it kept you on your toes.
Yeah, it did. So a couple of things, I guess, this week, kind of starting out earlier in the week, markets were actually rallying. Let's just kind of go back to Monday. As you said, the markets were actually doing fairly well on Monday and Tuesday. And it was interesting because markets were rallying into the inflation report. And the expectation was that inflation might actually come in a little bit weaker than what was expected. Now, that wasn't the case. It came in a little bit hotter than expected, but very likely, and we are either at or about to be at the peak of inflation as we have seen it so far. And the reason is remember, we talked about this, I think last week, that if you go back and we measure inflation on a year-over-year basis. So if you go back to the annual inflation rate a year ago, we were actually negative on an inflation basis. Now, starting in April, we're going to start having positive inflation numbers. So now when we compare back each month after April, we're going to have this increasing rate of inflation historically. So if prices don't keep skyrocketing higher on current levels, inflation as we measure it will start to come down. In fact, I am writing an article right now, and I did a chart on inflation. And I said, here, let's do a mathematical example of what happens with inflation. So inflation 7.5% as of this past Thursday. So January's inflation 7.5%. Let's assume now that every single month for the rest of this year, we have 0.5% inflation, which means that inflation will go up more for average home users by another 5.5% by the end of the year. That's pretty incredibly rise in prices. However, if we have a 0.5% increase every single month without fail from now until the end of the year, inflation will fall to about 6.9%. So this is that year-over-year comparison that we're talking about. Now, lay on top of this that the Federal Reserve is about to start hiking rates. They're doing this to try to combat this inflationary pressure they see in the economy. As we talked about last week, why do you hike rates? This is to slow economic growth. Why do you slow economic growth? Well, if I hike rates in an environment, then people borrow less money, they spend less in the economy. That means earnings slow down. That means economic growth slows down. That means you have less inflation. That's a function of why they do this. The other side of this also is important to remember, and this is part of the article that I have actually out on the website today at realinvestmentadvice.com, shameless plug, is talking about the Fed's next Minsky Moment. And what is a Minsky Moment? Hyman Minsky theorized that basically when you have a highly leveraged economy, you're going to create a bust, right? It's just a function of leverage in an economy. And when there's too much leverage in an economy and something changes, say hiking rates, it leads to an unruly unwinding of that leverage. And this is the big risk that the Fed is taking on now. Again, let's go back to 2020. We inject $5 trillion worth of liquidity into the economy. I give Adam a check for $1,400 a month. I give Ben a check for $1,400 a month. I give Susie. It's almost like an Oprah Winfrey episode. It's like everybody gets a check, right? So, it's a check for you and a check for you. Everybody gets a check. It's great. So everybody goes out to buy stuff. Well, we'd shut down the economy. Nobody was producing anything. So now you have this demand flux with no supply, so prices have to go up. Well, now we have the opposite occurring. Take a look at these manufacturing indexes as of late. Take a look at inventory reports. Take a look at the latest GDP report. GDP report for the fourth quarter. 75% of the growth of GDP in the fourth quarter was what? Inventory builds.
Restocking.
Bingo. So now I've got inventories coming up. And guess what? Ben, Susie, Adam, everybody else, they don't have $1,400 checks to spend anymore. So now I've got less demand, more supply. So going forward the rest of this year, what's going to happen with inflation? And look, you don't have to be a rocket scientist. This is basic economics. This is economics 101. So now you've got the Fed hiking rates trying to slow the economy at a time where the economy is just going to naturally slow in terms of inflation all by itself. This is the real risk for the markets, going forward. We've got a highly levered economy, highly levered stock market, very overvalued at a time where earnings are going to peak, inflation is going to peak, economic growth is going to peak because of Fed actions. Historically, that doesn't work out well for stock investors.
All right. Great points in there. I got a lot of notes here. You spoke at our recent Wealthion conference a few weeks ago. We had Lacey Hunt, basically kick it off with a ton of charts, basically saying, look, don't think inflation's not still in the driver's seat. It is, even though inflation's got the headlines right now. And then Jim Rickards came on and said, look, he thinks disinflation is going to be the trend for the year. Your comments actually echoed a lot of that, and you just made a good case for why, right? I'm going to prepare you.
Right. And real quick, I know we've talked about this before. And I know some people probably watching right now going, oh, yeah, they say this every week. That's, the only reason I'm reiterating these points is because of all the headlines we have going on in the markets right now about surging inflation, the Fed's going to, emergency rate hikes, all this type of stuff. We've got to go back and focus on the fundamentals.
Great. Right. And the whole purpose of these weekly updates is to keep people grounded, right? And I'm going to warn you when you publish your piece tomorrow, because I had the crazy idea to make that exact same argument about, explaining the year-over-year measurement of how CPI is done and doing pretty much almost the same calculations you did, just to let people know that the odds are pretty good that the inflation rate is going to start coming down, particularly starting around April, right? Because that's when we really began seeing the jump last year, right? And boy, are there a lot of people that disagreed with that premise. They might not have actually done the math, but they just said, look, price of everything's getting higher and energy is getting more expensive and wage price inflation's happening, and you guys just don't get it. This is it. This is the inflationary upward spiral. And look, not saying that couldn't potentially happen, but I think if you kind of look at the preponderance of what is more likely, you've already made the really good argument here. And again, I think it is important as well to kind of reiterate to people on this, because there are so many people here that are on team inflation, right? The inflation deflation debate's over. I just interviewed a guy the other day who said exactly that. Inflation deflation debate's over. Inflation is won. I got to push all my chips on the inflation side of the table. Hey, look, don't get me wrong. There's still going to be some inflationary pressures throughout 2022 for sure. But you got to keep your eyes open to the big picture here. And I think you just did a really good job of that for folks. This is good though, because it gets to the next thing I wanted to talk about, which is the CPI came out this week. As you just said, it's 7.5%, up from 7% in December. And people started to freak out about that number, thinking, oh my God, inflation's really beginning to take off here. Then Fed President, St. Louis Fed President Bullard came out and said, hey, yeah, I think we need to, get even more serious about containing inflation. And I think the Fed needs to get, 100 basis points by July, and we might need a 50 basis point one, to kick this off. And then we had the room where the news came out that there's an emergency Fed meeting this coming Monday. And for a moment there in the news cycle, everybody was just completely freaked out that inflation was just like going kablonkers, right? And that, oh my God, this is the end, right? And then we had today's news, which we'll get to in just a moment. But comment on that if you will, but I think that was sort of one of the hand grenades that got tossed into people's psyches this week.
It did. First of all, as soon as Bullard came out, made that statement about 100 basis point rate hike, it was, watching rats scramble off the ship, because all the other Fed members were like, oh, no, we never said anything like that. And Nick Timmeros over at the Wall Street Journal very quickly putting out articles talking about, nobody's going to be doing moving that quickly. Also, the Fed just released on Friday, they just released their open market operations, their POMO schedule. And that shows just a real steady pace of what was already expected. So that really kind of goes to the point that the Fed's not going to do anything really here to shock the markets. The markets are already under pressure. They know this. The biggest risk for the Fed is market instability. If you have an unstable market, that leads to a lot of other problems for the Fed. And so they're very sensitive to market stability. And with markets already under pressure now with this Russia thing, the last thing they're going to come in and do is do something to do shock and awe in the financial markets. By the way, just talking about 50 basis points hikes, do you happen to remember, pop quiz for all of your listeners today, when was the last time that the Fed hiked 50 basis points at a meeting? Any idea?
I'm not going to remember.
March 2000. All
right. Wow. That was a long time ago.
It was a long time ago. But the point is that was pretty much it at that point. So, the Fed's not going to do anything to come in and do shock and awe in the markets, particularly with Russia going on. They're going to be very sensitive to that. That's going to kind of work its way through the system here fairly quickly, and we'll kind of get set. And honestly, we saw that this morning. Markets, even after all that news yesterday, bond market was healing up. We had a big spike in yields yesterday after Bullard made his comments. Already this morning, markets were kind of, they were down a little bit, but, we were seeing bonds were starting to rally back here a bit. Stocks were kind of holding their own, not really, a huge change. And then we got the Russia story out this afternoon, which, just sent everybody scrambling for covers, especially not wanting to hold over the weekend, because too many things can happen over the weekend, particularly with a story like this. So, are we going to get a Russian invasion? My personal belief is probably not. This is a lot of political posturing, and yeah, it's certainly headline risk at the moment. But I think we have to look, kind of at the broader picture that, first of all, the Biden presidency is already under tremendous pressure, just, from poll ratings, et cetera. Even CNN came out today and said that there's absolutely nothing they see favorable about the administration so far. So, and after 20 years of Afghanistan and, Iraq and the war on terror, to turn right around and put troops on the ground in Russia, I just really, don't see that being a viable probability. Now, I'm not a geopolitical strategist. That is way outside my pay grade, but just trying to think about, how this plays out over time, I don't see the real benefit for Russia to do this. Again, I could be entirely wrong. But when it comes back to the financial markets, unfortunately, war happens to be good for financial markets. Defense stocks do well, bonds do well. As we've talked about numerous times, I still am a strong believer by the end of this year that bonds are going to be one of the better performing asset classes, particularly once we start getting into a more risk-off environment as the Fed is beginning to hike rates. So there's going to be some areas, regardless of what happens with Russia, to make some money. Just need to pay attention to where those are. Commodities, again, like you said, is probably another one.
All right. Well, all right. So commodities, right? So today commodities exploded, right? Oil was up 5% at one point today. Mm-hmm. And gold's done great. Lumber was up 3%. The ag commodities were all up. And the producing stocks all did very well too, right, on average. I guess I'll hand it back to you to say, look, is that something that could all go away on Monday if, Monday arrives and everybody says, oops, we were wrong. There's no invasion. In fact, everyone's kissing me up. Or do you think this is bringing the commodity complex to a new plateau?
No, if everybody comes out on Monday and says, just kidding, probably we're going to see a retracement, a lot of that. Just, there was a lot of positioning and traders kind of running into one area of the markets. But let's talk about something here in relation to inflation. And you kind of brought this up earlier that you had talked about this inflation run, got a lot of pushback on it because, hey, you got rising wages, you've got, higher commodity prices, you've got all these things. And that's absolutely correct. But you have to look at this also from the standpoint of how it impacts the economy. If I have rising inflationary pressures, right? So I'm paying more at the gas pump, I'm paying more at the grocery store. I've got a chart. I told you I'm writing about inflation this weekend's newsletter, and I run this one inflation measure, and I strip out healthcare and housing cost out of the inflation run. And the reason I do that is to
because
show
who needs those, right?
Well, no, it's not.
I know.
Right. No, it's not because we don't need those. It's because, well, Adam, right? You've got a mortgage on your house, right?
Yes.
Okay. Does your monthly payment change every month, or is it the same payment every month? Same payment. So inflation can go up or down because you're contractually locked in to your mortgage payment. Now, if you're renting your house,
the renters, but yeah.
Well, but renters are contractually locked in for a period of time, 12, 18 months, whatever it is. And then their rent may adjust, at some point down the road when their contract gets renewed. But for most people, healthcare and rent, or your mortgage, is contractually fixed for a period of time. So inflation doesn't move up and down in that aspect. And so the reason I strip that out of the inflation measure is to look at what is it costing me in all the other areas of inflation that I pay for every week: food, gas, my utility bills, those type of things. Now, what's that inflation number for me personally? That's 10%. So that inflation number is running a lot higher than even the 7.9% inflation of what people are just paying for to sustain their standard of living. Here's the problem: wages aren't keeping up with that. So here's my point about higher prices. If you have rising wages, that's great. Wages are going up, but that increased the cost of business, which reduces profit margins for business. So companies say, can't really afford to keep paying out these wages. So I'm either going to automate the job, or I'm going to get rid of that job and consolidate it, make one person do three people's jobs. And they start getting into a period of layoffs. Rising prices across the board contracts consumer spending when I can't keep up with the payments, right? I don't have enough money coming in. And this is why you see credit card debt on the surge, rising really lately, ever since kind of this extra liquidity ran out. Credit card debt is rising pretty sharply because people are going, I've got to go put some money on the credit card just to pay for groceries or gas or whatever that is. So there's a limit to all of this. So higher prices are inflationary, but higher prices in an environment where economic growth and wages aren't keeping up with that inflation actually is a deflationary pressure, because people will start taking actions to reduce that pressure, particularly on the stock market, on the business side. Business owners will start to take actions to reduce that wage pressure, that benefits pressure, that extra cost that's eating into their profit margins. So that's going to be the thing that later this year that we could actually see these things actually become deflationary as people have to start contracting their spending in the economy, and that's why we'll see slower economic growth ultimately as well.
Right. And not for nothing, we're seeing slower economic growth already here at the beginning of the year, right? We've been talking about the GDP Now forecast, which actually did get revised upwards, but to a whopping 0.7% so far for Q1. So, we're not starting the year from any particularly, elevated heights here. So a couple things about what you just said there. One, I don't know if you're familiar, it's inflation. It's a measurement of inflation put together by a guy named Ed Butowski. He's been doing it for years. And it's a basket of, I don't know how many hundred kind of everyday items. So it's supposed to be a much more practical measurement, sort of like you're putting together here. And he was saying for most metropolitan areas in the US, it was, running between like 8 to 12%. And this was before 2020. Like he was seeing rates like that before the whole explosion of all the stimulus and everything. So I haven't looked at it recently, but I got to imagine it's even higher for most of those metro areas here. To your point about everything you mentioned, I totally agree. On our last one of these sessions before we started recording, we spent a long time kind of talking about the impact of automation and the malincentive that business has to automate and to offshore and to just basically employ as few humans as possible. And of course, rising wage inflation just adds another, strong incentive to try to accelerate that progression. For folks that heard you and I talk last week about potentially sharing some of our pre-discussions with folks, I got to say I got all your messages. I got literally hundreds. We will share some of that in the future. We didn't have enough time for this particular one to do much talking beforehand, but I will promise in some of the future ones we have some good tidbits that we pre-record. I'll share them with you. But okay, so going on from here, Lance. I want to get to any trades that you guys have made at RIA there in response to what's been going on this week. But real quickly before I do, just one thing that I was sort of chewing on this week. We talked about Bullard and how we kind of inflamed the already agitated folks around the CPI print. Do you think in any way that might actually have been sort of sanctioned by Powell in a sense of, as Bullard was doing that, the market was coming down because it had started the week off well, like we said, but it started to sell off in terms of, hey, the Fed might be doing more aggressive, taking aggressive action here. Bond yields were going up on that panic. And in many ways, is that just an example of job owning trying to get this market to cool off a little bit, trying to get yields higher without the Fed, before the Fed actually has to think about doing anything, right? Could it have been part of a strategy to try to, grease the runway for the Fed here, where they may actually have to do less by the time they have to take real action?
That's actually another chart I have in my newsletter for this weekend, which is
spending too much time together. We're like in mind lock now.
I'm telling you, there's what we call a shadow rate, and there's a couple of different measures of the shadow rate of Fed funds and kind of liquidity. And if you take a look at the shadow rates, those are actually rising sharply, suggesting that, tightening is already well underway, even though it hasn't shown up on the Fed doing anything yet. And that tightening started in December, which explains why the markets have been under a lot of pressure so far, during the month of January and now into February. So, it's certainly definitely a situation that's going on. And look, the Fed is notorious for floating balloons, out before a meeting, and they'll have three guys that'll come out and say, we're going to hike rates, and three guys will come out and say, we're going to lower rates. And yeah, absolutely. They're floating these trial balloons out there to see how the market reacts. If they say, hey, we're going to hike rates and the market doesn't react too much, that's kind of a green light for them to go ahead and take some type of policy action of whatever it is. So they are certainly, putting that out there and measuring and monitoring that. Maybe James Bullard went off the rail and just kind of went rogue on the whole thing, because it was interesting to see how quickly the Fed started trying to cover tracks. But, I wouldn't be totally surprised if that wasn't kind of an orchestrated, kind of a move. It's like, okay, James, go out there and say we're going to hike 50 basis points. Let's see what happens. And when the market really kind of, sold off sharply, then I think that's where they started kind of cover their tracks. And again, we kind of seen a lot of little leaks here that, there's an emergency meeting, but, it's probably, since they just released their POMO schedule, probably doesn't mean they're going to hike rates by 50 basis points. Probably doesn't mean they're going to hike rates at all. Probably the first rate hike will be a quarter point in March.
All right. And last question on this, which is, we talked 10 minutes ago about how the inflation rate's more likely to start coming down as the year goes on, right? And if it does, just think for a moment. Let's say inflation does not increase, organic inflation doesn't increase month on month, it just sort of stays flat. And then we end up getting that April comparison where it jumps from like 1.4% in January to 4.2, I think it was in April. All of a sudden, the year over year inflation rate's now at a 3 handle, it's 3 point something. Do you think that the Fed is kind of looking at that and hoping to be able to say, yes, we're gonna hike multiple times this year. Maybe they even do a quarter point rate hike, but then April comes in, they're like, oh, inflation's down to 3%. Well, our job is done here, right? Do you expect that as sort of a potential dovish pivot risk at some point here?
I think there's a real, I wouldn't say that they're going to go one rate hike and done. Yeah. But there is a possibility of that. Honestly, it's one of those things where the Fed is going to try to hike rates. And if inflation comes down faster than they expect, you have a bigger market correction, and particularly one that begins to threaten margin debt. which is a correction of about 20% in the markets, or you have, a deeper than expected slowdown economically, they're going to back off the pedal. So the question is really, where does that occur? So the first thing is if they see inflation coming down, they'll go, okay, well, what we'll do is let's not have one, we've hiked rates twice. We're going to wait a meeting and see kind of what happens. And then they may hike another potential. But if we really start to see the market starting to come apart, if you really start seeing the economy slow down faster than expected, then I think they're going to start talking about very quickly, backing off rate hikes a la 2018, which is, oh, we're nowhere near the neutral rate. 2 months later, we're right at the neutral rate. So we've seen how fast that their narrative can change depending on economic growth, depending on markets and inflation.
All right. And at what kind of inflation level do you think the Fed starts saying, okay, we're good here, right? So in other words, it's not like they're going to say, hey, our goal is to get prices back to where they were before this recent spike. Like we're pretty much, to some people's expectations, we're pretty much stuck with these higher costs now for the most part. I mean, yes, supply chains will bring down the cost of certain things, but it's not like we're going to go back in time to, the halcyon days of 2019. So is it more kind of once it gets back in the like 2-ish% rate where the Fed can be like, okay, we can live with this?
Remember two things. First of all, about 2 years ago, the Fed said that they're going to start using this inflation averaging method, right? So for a long time, we were talking about 2% inflation. We just want to get inflation above 2%. And no matter what they tried, QE, interest rates at zero, everything, they could never get inflation above 2%. And so when they started seeing inflation come up a bit, they then kind of changed their tone. They said, you know what, we're going to let inflation run hot. We're going to start doing inflation averaging. So we're going to look back over the last 3 to 5 years. And as long as we're somewhere around that 2-3% inflation range, we're all good. So that's going to be, I think, once you start to see inflation come back down into that, high threes, maybe, just slightly below sub 3, you're going to see the Fed start to back off policy, assuming that everything else is status quo, right? So we haven't completely, we're not in a recession where the markets aren't down 30%. Assuming that only somehow magically for the first time ever in history, the Fed is actually magically to bring down inflation and not blow up everything else, that somewhere around that 2 to 3% range, they're going to start backing off the pedal and saying, okay, I think we're good. Unfortunately, we're going to have inflation sub 2% with economic growth sub 0 and probably markets down 20 to 30% before they get there.
Boy, and that just sounds like an awful lot of fun. All right. So I've been keeping you at the macro. I want to pull this back to the market level. What trades, if any, are you guys, or changes to your portfolio, if any, are you guys making given the past week's developments?
So we talked about when the market ran up to the 50-day moving average that we were going to increase our short positions, which we did do that. And our most unpopular trade this week is adding to bonds. So we bought more TLT this week. And every time we do, everybody's screaming like, I can't believe you're buying bonds. Well, that was a very nice hedge today with the markets, down as sharply as they were over this Russian invasion. So you got to remember, and that's also another good point about treasury bonds right now. Going back to the Russian event, if Russia does invade the Ukraine, NATO gets involved, we're now involved, and we're sending bombers over, and the whole 9 yards, and this thing's just really kind of coming apart at the seams. If you're anybody, Russia, Ukrainian, Germany, which is right on the border of Ukraine, France, England, if you're anybody of any consequence and you've got money in those countries, what are you going to do with it? Particularly if you're in the Ukraine, you're going to send it out of the country to somewhere else. And the only place to send it is the US. I mean, everybody wants safety and security and liquidity of their capital. So if I'm concerned about geopolitical risk in any form, I'm going to convert my foreign currency into US dollars. So the US dollar will strengthen. And those US dollars will then transfer into treasury bonds, sending bond prices lower, sending bond prices higher, yields lower. So that's exactly what we kind of saw today, is that kind of that first initial kind of flush. We saw a lot of money running into bonds today, that risk off type attitude. But if this thing becomes a much more, grounded effect in the Ukraine, and there's actual, conflict emerging, the one place that people all over the world are going to want to be is in the safest security in the world, which is US Treasuries. So, don't dismiss the value of security and liquidity in a geopolitical event.
Yeah, and like it or not, that is the world's number one go-to safe haven is long U.S. Treasuries.
Right.
So I was talking with, I interviewed Felix Zulauf recently, and irrespective of the Russia situation, we weren't taking that into account at all. He was sort of giving his forecast for the year, and he thinks that bond yields are topping out right now, and he expects them to go down fairly substantially by summer. And for the US 10-year, he was basically saying he sees that going down from a high of about 2, which is where it's been today, down to about 1, right? And if you could just comment, if you own an instrument like TLT, which you just mentioned, if you can explain what that ETF is, and what kind of return would you get on an instrument like TLT if indeed you had bond yields go down by half?
So basically, TLT is an ETF that owns treasury bonds. And, again, when we build our bond portfolio strategies, we look at measuring duration. How much duration do we want in our portfolio? So our portfolio right now, we own some T-float, which are floating rate treasuries, which are very short in duration. We had a little bit more exposure to kind of that 1 to 5 year duration on treasuries. Now, we recently sold those off and we moved our duration out towards the 10 and 20 year durations of treasury bonds. So we've lengthened our portfolio duration to about 7 to 12 years right now, if you kind of break down our overall duration. The reason you want more duration, if interest rates are coming down, the more duration that you have in your portfolio, the more increase you will have in the price of bonds. So it all has to do with duration. If I have a very short duration and interest rates move up or down, I'm not going to get a lot of price movement. But if my duration is longer, I get a lot more price movement. So if interest rates go from, say, 2% to 1%, you're going to be looking at a capital, and this is why we own bonds. We don't own TLT for the yield, right? It yields 2%. So, right now it's yielding 2%. I mean, that's not why you own bonds. The reason we own bonds is for the capital appreciation event that occurs. And just as an example, TLT was up over a percentage point today. Hold on. Let me verify that point real quick. Yeah. So yeah, TLT was up about 1.5 points today, just with the small movement in interest rates. So if I own treasuries now and interest rates go from 2% to 1%, I'm looking at somewhere between a 20 and 25% increase in TLT just from the decline in rates. So again, if I'm long, and again, this just depends on your duration of your portfolio. My portfolio will probably go somewhere around 17 to 20% on the bond side because my duration isn't fully long at this point. Now we're going to continue to move that duration out. So as we kind of get there, but with rates here at 2.25, and the reality is probably 2.25 is going to be about the peak in rates. There's a long-term downtrend that exists going all the way back to 1980s. About 2.25% is about the maximum you're going to get out of this rate increase before you start impacting economic growth due to leverage, mortgages, those type of things. The 30-year mortgage is up over 4% right now. So if I was thinking about buying a house now, maybe I postpone it, hoping rates will come back down again, or maybe I can't buy the house I wanted because I can't afford the payments anymore. So, we're getting to that point to where rates are going to start impacting the economy. So if I'm long bonds and those rates do fall as economic growth slows, and again, pay attention to the yield curve. Can't enforce that enough. The 10-2 yield curve is dropping sharply here. So if we see that yield curve begin to invert, which it will likely invert in less than 12 months from now, that's really going to start to flow through to a weaker economic environment, lower interest rates, higher bond prices. And that's why I keep saying, I kind of keep reiterating the coin here. I think bonds are going to outperform stocks this year.
All right. Well, like I said, Felix Zulauf, I think, agrees with you, at least for a good chunk of this year. Our other endorsed advisors at Wealthion, the guys at New Harbor Financial, they just said that they are looking very seriously about adding more bonds to their portfolio as well. I want to underscore this because I think most viewers watching this get stocks well, but don't get bonds as much. And so I just want to flag for them what professionals like you are doing right now. And very much seems that you're saying, hey, the prospects for bonds are continuing to look better and better. And again, we're talking about government bonds here, treasuries, and we're specifically talking about kind of longer dated ones. Corporate bonds may be an entirely different story. Don't know if we have time to get into that yet, Lance.
Yeah, well, that's a conversation we can have someday. But corporates really come down to fundamentals, cash flow coverage, those type of things. So, not all corporate bonds are created equal. And when money flows into safety, they flow into treasuries because that is a government guarantee, right? So I've got a guarantee of payment from the government, and it's highly liquid. I don't have to worry about mark to market and all that with that I do with corporate bonds. So, if I'm looking for a safety trade, it's always treasuries. Corporate bonds have their place, municipals have their place. But again, when you get into corporates, municipals, mortgages, those type of things, those have some different variables you have to be aware of, right? I mean, a municipal bond from the city of, or from Illinois or Chicago is very different than a municipal bond from, Dallas, Texas. So it depends on, the cities, what's behind it. I mean, there's a lot of things that go into it that you really have to analyze, but treasuries, it's kind of, what you're getting.
Great. And folks, I think we've mentioned in the past that we'd be willing to do a sort of a deep dive in one of these episodes on bonds, just sort of writ large. If there is indeed strong interest in that, just let us know in the comment section. And if it's high enough, we'll definitely do it soon. Sure. All right, Lance, we have, as always, just blown through my timing target for this. Sorry, folks, for going long, but Lance just keeps giving such great information. So as we wrap it up, Lance, again, I always try to leave with something that's really pertinent to the individual investor who's watching this. Anything that you would want to put in their mind right now, given what's happening right now?
Yeah, well, first thing is I didn't finish everything that we did this week. We also reduced exposure to some of our tech stocks this week. We still like a lot of companies: Apple, Google, Nvidia, AMD. We like these companies long term for a lot of reasons, but again, just higher interest rates don't play well with technology stocks right now. Now, that's going to be a great opportunity when we start seeing this disinflationary pressure show up. And again, you saw this on Monday, Tuesday, when there was rumors that inflation might come in weaker, tech stocks took off. So once you begin to see kind of disinflationary pressure show up, you'll want to be back on the growth trade. But we're reducing that exposure right now. We've pulled about 20% of our equity exposure relative to our portfolio off the table. So we're holding a little bit higher levels of cash. We've got a short position, been adding to our bonds. So we're getting more defensive here. But again, the point of my conversation is be careful about going all in one direction. This is one of the traps people get themselves into. And I think we touched on this last week. You jump all into one trade. I'm going to bet on the inflation trade, or I'm going to bet on the deflation trade, or I'm going to bet on this trade or that trade. It's great if you win, but it's kind of like going to Vegas and betting all in on a hand of poker. If you win, it's great. If you lose, not so much. But you don't have to do that in your portfolio. You can make those bets, but always leave yourself some hedge just in case you're wrong. And this is why we just move slowly. We have talked numerous times on this podcast about it's a game of inches. We make small changes, see how it works, make more changes, see how it works. If we're wrong, we adjust. And we're going to be wrong sometimes, and we're going to be right sometimes. And so the goal is simply just to try to make these small moves that don't damage your ability to generate longer term returns. Because again, we're talking about a lot of events that may happen over the next 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months, but we're investing for 10, 20, 30 years. So it's important, as just what we're talking about with duration with bonds, we also have to remember the duration of our portfolio relative to the duration of the events that we're talking about.
Well, absolutely. And before we hopped on here, we were talking about some of the investor psychology that you're seeing kind of plague people right now as things get more volatile, where people are kind of obsessing about the tape and what it did today, right? Oh my God, I'm down X today, or I'm up Y tomorrow or yesterday. And it's a great reminder. And this, I think, is a great reason why folks should work with an advisor who can kind of take this daily emotion off of most people's plates. But that this is a game of inches, but it's a game of net inches on average, right? So there are going to be days where you're ahead, there are going to be days where you're behind. It's a couple steps forward, couple steps back, but the goal is over time to make net forward progress, right? And so, I think my kind of key contribution to this here for folks is don't obsess about the tape, because when you do, that's when your emotions begin to play in, right? The fear or the greed part, and you start making decisions in reactive mode, which is exactly what you don't want to be doing as an investor, particularly in a volatile environment. It's the fastest way to lose your money.
Absolutely.
All right. Well, with that, Lance, another great week. We'll find out. Monday's going to be interesting because we're gonna get a lot of news to react to one way or the other. But whatever next week's brings, we'll be tracking it on this program together again. And before we meet up virtually to record this next week, we'll be meeting up in the real world because I'm going to be zipping into Houston and I'm going to get a chance to meet you and your team. I'm looking forward to that.
Yeah, I forgot. Are we doing barbecue or Mexican food? I forget.
I don't know. I'm kind of hoping both.
That might be an interesting lunch, but we'll see if we can make it happen.
All right. Well, thanks so much again, Lance, and I'll see you in Houston next week.
See you.